If you're an Oregon public employee approaching retirement, there is a provision in many governmental 457B plans that can allow you to significantly increase your retirement contributions in the final few years before you stop working. It's called the 3-year catch-up provision, and when it's used correctly, it can allow someone to defer close to $150,000 in additional retirement savings. Hi there, Brenna Baucum with Collective Wealth Planning. The rules are a little nuanced around this, as they are with most Oregon PERS elements, and the timing matters quite a bit, so let's walk through how this works. First, what is the 3-year catch-up? Normally, retirement plans limit how much you can contribute to them each year. So, for example, in 2026, the contribution limit is $24,500. If you're over 50, that increases to about $32,500, and between the ages of 60 and 63, it's about $35,750. And that applies to 457Bs, 403Bs, 401Ks. That's across the board. But 457Bs have this additional catch-up. Frustratingly, these are all called catch-ups. But so during the last 3 years before your plan's designated normal retirement age, the IRS allows an exception for 457B plans. During that window, you may be able to contribute up to roughly double the normal limit, around $49,000 total per year. So let's talk about the plans that this is available in. This rule itself, it comes from federal tax law that governs governmental 457B plans. So it's not specific to PERS or Oregon. But here in Oregon, many public employees use the Oregon Savings Growth Plan for their 457B through VOIA, but depending on your employer, you may be administered by Empower or Mission Square. There are a couple of others out there. So the rule itself, it's not specific to VOIA, it's not specific to Mission Square or any others. Again, it's an IRS rule, but whether that catch-up, that 3-year catch-up we're talking about is available, it depends on your plan and what your employer has adopted. So that's maybe step 1 is checking in if your 457B plan allows this. So let's talk about the detail, right? Not everybody automatically qualifies for the full $49,000 catch-up. The IRS limits the catch-up to the lesser of double the annual limit, that's that $49,000 number, or your unused contribution capacity from prior years. So this provision, it's designed to help people who didn't maximize contributions early in their careers. So if you had years where you contributed less than the overall limit, then those unused amounts may allow you to contribute more now. So your plan administrator typically calculates for that for you. I will say that I have never met someone who has consistently maxed out their 457B plan through the entirety of their career. So very likely you have some unused contributions from prior years that you could draw on. All right, let's talk about timing. So the catch-up provision is tied to something called your normal retirement age, or NRA, within the plan. This is an age that you elect with your plan provider. It's not automatically your PERS normal retirement age, and it's not necessarily the exact date when you stop working. It's just the age that determines when your 3-year catch-up window begins, and again, it's determined with your plan administrator, so VOIA, Mission Square. Your catch-up window is the 3 calendar years before that age. Once it starts, it runs for 3 consecutive years. It cannot be paused or restarted, even if your employment situation changes. So this is especially important if you're planning a PERS work-back arrangement, where you retire and then return to work and start collecting your pension. You will want to make sure that PERS, your plan administrator, and your employer are all on the same page with your plans of what you intend to do and have signed off that the 3-year catch-up works with your arrangement. So let's think about the situations in which this might be useful. This strategy really comes into play when income is the highest. So for example, the work-back rules I just mentioned, right? When you're collecting your salary or close to it, so you're going up, you're working, you retire, the next day you return to work, you start collecting whatever that new pay structure is. Maybe it's the same as your salary, maybe it's slightly less, and you're collecting your pension. So for some people, that can be quite a bit of income. Could be also if you receive a large leave payout or that kind of thing. In these years, taxable income can increase significantly. So being able to defer another $40,000 to $50,000 a year in a retirement plan can really help reduce your taxes while increasing long-term savings and being the catch-up that it is intended to be. I have an important note for you about Roth versus pre-tax. So you might have heard that starting in 2026, high earners must make catch-up contributions on a Roth basis. That applies to some retirement plans. However, under current IRS guidance, the 3-year catch-up for governmental 457B plans is not required to be Roth. So that means these contributions may still be made on a pre-tax basis depending on your plan, which is, again, where the tax efficiency comes from in this strategy. So, in closing, because plan rules and eligibility can really vary, it's important to confirm how this works with your specific 457B plan. But for most public employees approaching retirement, the 3-year catch-up provision can be a really powerful way to increase savings. Just requires thoughtful planning, especially around timing. If you want a thought partner as you navigate this or anything else, it's all very complex, right? Retirement is complex. Retirement income is complex. Taxes are complex. And certainly anything coming from the IRS is complex. So if you want a hand navigating it, don't hesitate to reach out. Thanks for watching.